Welcome to another edition of the Up Your Assets podcast, hosted by Ray Ferrara, CFP founder and executive chair of Provice Management Group, LLC. The following presentation is for general information purposes only and not personalized advice. Seek out a professional before making any financial decisions. Additionally, no guests pay to be on the show or are paid to be on the show, and the opinions expressed are their own and not the host's or the show.
Hello and welcome to another podcast of Up Your Assets. I'm your host, Ray Ferrara CFP, and I'm the executive chair and founder of Provice Management Group, located in Clearwater and Tampa, Florida. Today, we're going to address managing your retirement plan and maximizing the ways that it can help you plan for retirement. It is our pleasure to have Jon Brethauer, CFP, MBA, and president of Provice Management Group, to join us for an in-depth look at retirement plans from a participant's point of view. How much, when, and how does a participant maximize the experience of being in a retirement plan like a 401k, 403b, or other retirement plans? So, Jon, welcome to Up Your Assets.
Thank you, Ray. I'm excited to be here.
Well, Jon, from the point of view of being a participant in one of those retirement plans, what should investors be cognizant of about their retirement plans?
Really need to take a look at what their own plan looks like, because they differ so greatly from plan to plan. And what they also should be looking at is when can they get their foot in the door? Eligibility and entry dates change vastly from plan to plan. And I want to make sure these folks are getting in as soon as they can to take advantage of that, time compounded money that we all hear so much about. So I think understanding the eligibility should be the first thing. When can I get started in getting in this plan? How's the matching formula look? What does that mean? Is it a safe harbor plan that I'm getting a guaranteed 3% non-elective? Is there a matching formula? Maybe I'm a highly compensated. Well, if I'm highly compensated and we don't have a safe harbor match, now I'm maybe a little bit worried that I might have to give back some of those K dollars because we didn't pass discriminatory testing. I think those are just a couple of the key features. And I think what's more typical is folks are looking at their investment options, right? Let's look at that fund lineup. Let's make sure that we have some names that we're familiar with and have good performance. Obviously very important. And I think one of the hottest topics lately is Roth versus traditional K investing. Which one is right for me? And do I even have the ability to do Roth contributions? And then I think, how do we access this money? Of course, we all plan to be at our current jobs until we retire, but we know sometimes that isn't the case. So, how does this money eligible for rollovers? Am I able to access some while I'm still working, through loans or hardship provisions? So I think understanding the ability and the constraints of the plan is a great first step to getting started in your plan.
Well, you've mentioned a lot of important areas, and we're going to dive into some of those. Jon, I think one of the most overlooked things from a participant's point of view in getting into a plan is at least putting in as much as you can to get the maximum match from the employer. If it's the employer is going to match some specific amount, it's almost like it's a free money or an investment return for that 1 year of that employer putting in additional money on a participant's behalf. How do you get a participant to make sure that they're doing at least that as a minimum amount into their plan?
Great, that's a great point. We call that the golden rule for 401ks, is make sure you're taking all of that free money from your employers that are being offered to you. And sometimes it's not easy to get up to that level, but that is usually our first goal with working with a new participant, is at least getting to where they can get all of that free money. And I think one of the best analogies to use is in the investment arena, most folks are looking for an 8% plus or minus rate of return, right? If we can get 8% a year, most folks are very happy with that rate of return. Well, guess what? Those employer matches are sometimes 100% of what you're putting in on the first 3%, or maybe they're 50%. Well, 50% rate of return sounds pretty amazing when we're really just hoping to shoot for 8%. So when you look at it from that perspective on how much that employer match is bolstering your own retirement savings, it's imperative that we get all of that we can in pretty short order and not let that go by for too many months before we can get all those employer dollars.
Well, of course, we want to make sure that people understand that's really not an investment return, but it does improve the amount of money that you have in your plan. And it is essentially like getting a little bonus from the employer. So what are the biggest drivers in choosing traditional versus Roth K contribution?
Sure. Well, I think customarily, folks in higher tax bracket always wants to take the bird in the hand. What does that mean? That means they tend to lean toward those traditional K contributions, meaning they get a tax benefit right away. But what we really need to look at is what's best for the long term, not just for today. And getting that tax break, of course, feels great. But what kind of position are we going to put you in retirement? Given that tax brackets are actually near historical lows, does it make sense to go ahead and pay the taxes now and have that tax-free growth for a long time? I think it's an easier decision when folks are starting out, they're younger, maybe they're not in those high tax brackets. So to pay 12%, to pay 22% and have that money grow tax-free from 20 to 60 or 70, I think that's almost a no-brainer for most folks. Where it starts to get interesting is those higher income earners, you hit a certain point and there's not enough time in there for you to make that up. So, still someone in their 60s, a traditional 401k may be the best opportunity if they're in that high tax bracket. But what we're seeing is even folks that are maybe in their upper 30s or low 40s, even with that high tax bracket that they're in, sometimes are better suited for the Roth provision when we look at those 30-year projections down the road showing that compound of tax-free growth. So we're really looking at what position are you in today and what position do we think you're going to be in the future? Obviously, we don't know longevity and we certainly don't know what tax rates are going to be. Although I think that if we were placing bets, we have to place bets that the tax rates will move up more than they would move down over the long terms. That I think also puts another feather in the cap of the Roth K contribution.
So let's be clear. The Roth contribution is not tax deductible, but it grows tax deferred. And when you take it out at some time in retirement, it comes out tax free. So those that are in a low income tax bracket, that might be a better consideration than taking a traditional approach where the contributions are tax deductible and the money grows tax deferred, but when you take it out, it then becomes taxable. So a lot that goes into making a decision between a Roth or a non-Roth traditional contribution. Jon, in the One Big Beautiful Bill Act, there was a provision in there that for those that are doing catch-up and over certain income levels, they have to go into a Roth IRA. What do you advise people in that regard? Not do the catch-up, or go ahead and do the catch-up and just realize that that you're not going to get a tax deduction?
We would certainly encourage them to go ahead and make that super catch-up, even though those are going in Roth dollars. And even if you're in a top tax bracket, when you look at the landscape of where we can get tax preferred contributions, very, very limited, especially as you move up the income chain, you get phased out of IRAs and Roth IRAs and things of those nature. So we think if you have the ability to stock away some money that's going to grow tax-free, you should absolutely take advantage of that. And as it is today, that extra would be $11,250 on top of your $23,500 that you can make for your core 401k contribution. So it is a substantial increase on that catch-up, which would normally only be $7,500. So again, for a lot of Americans that are playing catch-up, we think it makes a lot of sense to move forward with that Roth mega catch-up option.
So there's two catch-ups in play right now. One is if you're 50 or older, what I'm going to call the traditional. And then if you're 60 through 63, you get a super catch-up of some additional money that can be put into the plan. Is that correct?
That is correct. I'm not sure how they pick those ages, but if you are 60 to 63, you get those super catch-up options. And for those that are 50 and over, get the 7,500. So for a small window of a couple years, you can do that super catch up, which is why we think it's so important to take advantage of it, because you won't have it for very long.
Jon, suppose I'm a participant in a plan. Should I worry that I'm only in one target date fund? It seems like all of my eggs might be in one basket. What should I be worried about, if anything?
Luckily, Ray, you don't have anything to worry about. I'm so excited that participants hear about diversification and they're questioning it. I think that's great news that they're engaged in their retirement planning and their investments. But the great thing with the target date fund is it's not really one fund, it's a fund that owns many funds. So when we talk about diversification, a target date fund typically is going to own hundreds of different stocks and likely thousands of different stocks, even though you only own one single fund. So target date's a great place to get diversification. And we like to say it, if you're not really engaged with your investments and you don't enjoy following them and making changes to it, you want a more of a set it and forget it option. The target date fund is your place because not only is it going to give you great diversification, they're going to make sure you're balanced between asset classes. They're actually going to reduce your risk as you get close to retirement. So many of us don't want to take the amount of risk we took in our 20s that we do in our 60s, especially with much bigger balances in our investment accounts and 401ks. So this allows us to reduce the volatility as we get closer to needing those monies. So the target date fund is actually a great place to invest. And for folks that maybe aren't as engaged with it, you're still getting professional management. The returns are there. There's no additional expense for any of these pieces as well. So it's a great option for a lot of plan participants. And quite frankly, we usually see anywhere from a third to 2/3 of a plan go into these target date funds because they're so easy to use. And I think they also help safeguard against ourselves. A lot of times, the investor is our worst enemy. Emotion grips us during times of economic uncertainty when the markets are pulling back and we're thinking about should we go to cash, should we move to safety? But I think a lot of times when folks are reliant in the target date funds, they know they have that professional manager, so they know someone is looking over it with a lot of expertise. And I think they have more comfort in letting that ride. And as we know, if you sell at the bottom of the market on a consistent basis, your returns are not going to be where you want them to be.
So, John, a lot of people advertising on TV from an investing point of view, and particularly on retirement. But should I invest in a company's plan even if I don't recognize the brand names of the provider? Maybe they're good, but they're just not on TV. How do I know it's going to be a good plan?
Absolutely. And I have a great story to share on that one too, Ray. But the brand recognition is not the most imperative thing. I think most of us heard of Fidelity and some of Charles Schwab and Vanguard, some of the big players out there, but there's a lot of great K platforms that you're maybe just not aware of. In fact, we had a plan that used one of those lesser known plans, and I met with one of the executives about a year after he'd started, and he had told me that he's never invested in the plan, had enrolled, and I asked why. He said, "Well, I've never heard of this company before." I said, "Okay." So we started going through what are the important things in that plan. Fund lineup. Well, this plan structure allowed us to choose any mutual fund under the sun. So we have 12,000 investment options to choose from. They were extremely low cost. So most of those investment returns are actually going back to the investors who put in those dollars. And it had a lot of flexibility and technology with it as well. So once we were able to explain all that, this person went in the plan. And again, this person was a high income earner, wanted to defer some income. So, you can't just go off of the brand name to know whether it's a good plan. You really need to dive down into it and look at some of those items we mentioned earlier. What's that fee structure look like? What are the funds within the plan? Those are the important things, not whether or not we recognize the name on our website.
John, let's take a typical employee now becomes eligible for the 401k, and let's say I'm thinking about waiting to contribute to the 401k till I get settled in. Maybe I've got some student loan debt to take care of, some other things that I'll be able to wait until I can contribute at a greater level. Is there any harm in just waiting and then trying to catch up a little later?
There sure is, and the numbers prove it, Ray. In fact, Albert Einstein once said that compound interest was mankind's greatest invention, and some claim he called it the eighth wonder of the world. Whether or not any of those are truth or tale, I'm not sure, but it really shows the importance of getting started early and letting these dollars compound with each other. So we looked at a case where someone was deciding between, do I get started right away in my mid-20s, or do I wait till, I get married and have the kid and a little more settled? Maybe I've advanced my career a little bit. I'm only going to wait 10 years, but I'll be able to put a lot more in. That person that waited 10 more years had to put in 4 times as much every year up until retirement to catch up with the person that started 10 years earlier. So it makes such a big difference to get those dollars going and let them snowball for you. Let your money make money for you, and you will have a much easier road to retirement.
John, I've said for a long time that saving money is a lot like exercise. It's something we know we should always do, and we're always going to start tomorrow. And then for those who do wait, again, drawing the analogy back to exercise, if they try to put in that extra amount and a little bit more, just like if they go back to exercising after not exercising for a long time and they try to do those 50 push-ups they used to do when they were in their 20s, it hurts and they stop exercising and lose the benefit. Same thing happens in trying to save money. If you try to wait and then save a lot of money, it cuts down on your lifestyle, everything else, it hurts, and then you don't save as much. So you're right. Getting started early can really make a huge difference in a lot of different ways. Jon, let's suppose I'm in a plan. How can I find a little extra money each month to go towards my retirement? I mean, we're dealing with inflation. We're dealing with the economy right now in a very unsettled area. How can I find extra money to put into the plan?
Right. This is probably one of the most common conversations we have with participants. They want to save, they know they need to save, but finding the ability to save is what's stopping them. So a couple ideas we look is to try to save some costs, but not make significant impacts to their lifestyle. So what are some of those things? Well, it could be as easy as reviewing our auto, our home insurance, and seeing if any bundles are available. I learned a long time ago that it was important in my mind to use an independent insurance agent, someone who could go across multiple carriers and find what the best deal was for me, each and every year. So I think looking at some of those things are a way to find some dollars pretty quickly and sometimes some very large dollars. I think also what's happened over the last couple of years is these subscriptions have really started to bubble in and infiltrate our cash flow. Sure, it doesn't sound like much. I have Sirius Radio for $5, and I have Amazon for this, and I have HBO for $15, and the Peloton for 40. Well, next thing you know, I'm having $1,000 of my monthly income gobbled up through these subscriptions. So I think we just make sure that if you're going to be spending dollars on it, that they're adding good value to your life. Make sure that they're having a good impact for you, and they're not something that if they weren't there, you would miss it. If so, I think that's a great opportunity to maybe carve some of that out and find a little bit more cash flow for you. You mentioned inflation. I think the place we felt it maybe the most is with our food, whether it's going to Publix. Certainly eating out has gotten a whole lot more expensive. So a lot of folks are now bringing their lunch and saving what used to be $5 to go out to have lunch. Well, now it's $15 or $20. When you times that by 3 or 4 times a week, that's another hunk of money now you may be able to find for that retirement plan savings.
And Jon, again, going back to my exercise analogy, when you start going back to exercising, instead of trying to do those 50, maybe you do 15 and you work your way up to 20, 25, 30, and perhaps more. The same thing's true with money. When you start saving, if you're saving on a percentage basis, the good news is that each year as you get a raise, you're always putting a little bit more in, but it also doesn't hurt to, even if it's just an extra $10 a paycheck, increase it from time to time. And the next thing you know, you're really socking away a lot of good money. But if I do all of that, and then let's say I encounter an emergency, am I able to utilize any of the money in the 401k, or is it locked away until I retire?
Well, you can get to it in most plans, which is a nice advantage. Now, it's not like a bank account where you can just go in and pull money anytime you want. Typically, a plan will have a loan provision, so allow you to take some money out. Typically, it's one loan. It could be more than one, and that's limited to 50% of your account balance, but no more than $50,000. So that's one way. Another one is if you have a hardship, and there's a hardship provision in the plan. So these are usually very tough circumstances. Maybe we're in foreclosure on the home, a lot of medical bills, disability, things of that nature. That will spark that opportunity to be able to take monies out for that reason. And what we've seen as well, especially in the state of Florida, is there are some disaster relief provisions we can put in plans. So that's one amendment that we've been encouraging all of our plans here in the Bay Area to use is that federal disaster provision, so that if someone does need that money and they are in a federally declared disaster area, not only can they take that money out up to $22,000, they don't pay any penalty on it, even if you're below 59 and a half years of age. And you have 3 years to pay that money back or spread out the taxes on those over that, um, pull from your retirement plan. So you do have some ways to access it. I always tell folks, mentally, you want a plan that you never touch it. But in case of emergency, there are usually a few ways we can break the glass and get our hands on a little bit of it.
So, Jon, what's more impactful to my retirement planning? Is it investment performance? Is it the company matching that you talked about earlier? Or is the most important thing how much I contribute in the first place?
Absolutely what you contribute. Although we hear more about the investment performance and the company match than we do on that piece. I actually run into participants that refuse to put money away because the employer doesn't put any matching dollars in. And unfortunately, it is up to the employee to set ourselves up with retirement funds. The days of the pensions are gone. Yes, there's still a few around, especially if you look into maybe government and some places like that. But for most of corporate America, the pensions are gone. And that onus now is put squarely on the employee to build that nest egg for themselves. No matter if the company is matching or not, we really have to be put more of that weight on what we're putting into the plan, because that's the only way we're going to get to a successful retirement plan. It's not going to be on a 3% match or one fund earning 20 basis points more than another. It's going to be about the dollars put in that plan.
Jon, thinking about that from an investment side, it's often said that as you get closer to retirement, you want to make it more conservative. There's kind of a maxim that's out there that says, take your age away from 100. And that's how much you should have in stocks. So if you're 30, it ought to be 70% in stocks. If you're 60, it ought to be 40% in stocks. Is it true that once a person gets close to retirement that I should not own any stocks because they've become too risky and I need to really button it down?
Ray, I would actually tell you that probably is too much risk to not have any stocks in your portfolio at that age. And what I think the easiest example to explain is what we've seen with inflation over the last couple of years. You may have spent $100 a week at the grocery store 4 years ago. Today, you're spending $200 a week. And so, what's the best way to combat inflation? It's to own stocks and other equity investments. We think that mantra is actually a very risky mantra to go into all fixed income and cash type of instruments when you're retirement. Moreover, folks are living a whole lot longer now. We have clients that are well into their 90s and they need that equity exposure to make sure that they're earning a return over and above inflation. So they actually have a real return that they can build upon. So that's one area that we're really trying to educate participants on, is making sure that they don't go into, an all cash or just an overly conservative investment allocation once they get to retirement. 30 years is a long time to draw off a portfolio. So we want to make sure that it's going to be sustainable and that you don't have to change your lifestyle during retirement.
Jon, Roth, non-Roth, how much, investment choices, emergency funds if I need them. All of this seems really daunting to coordinate my investment, the taxes, retirement income, with so many changing factors. Where should I look for help?
Right. I think this is where the expertise of a certified financial planner could really help someone immensely in preparing for their retirement. These factors you mentioned are always changing and they're different for everyone. What works well for someone, the other person may have different objectives, different goals, and that approach is not going to work. So I think engaging with someone who's focused on your situation, looking at your tax brackets, looking at your IRMA brackets, your cash flow sustainability, those things are imperative to having successful retirement. So I would really encourage someone to engage with a CFP designee and allow them to create a long-term financial plan for them. I know a lot of these items, one of them may not seem overly critical, but they're a series of ongoing decisions, and they can have a major impact if we lose sight of one of those to our retirement. And in our eyes, it's not about hitting that home run ball. It's about a lot of singles and doubles that move us around the bases and avoiding those strikeouts. And I think that's how you get that successful retirement.
Jon, thanks a lot for being with us today. Any last words that you have for those 401k participants?
Keep saving. Make sure that you're getting in early and often, and let that snowball, let those assets that are compounding, let them work hard for you and take a little bit off your shoulders later in life when you're getting close to retirement.
And thanks for being with us here. Now, everybody, go out there and up your assets.